Assalamu alaikum. So it's not Anwar today, unfortunately. It's Naim Kadwa going to be presenting today's show. Sorry that unfortunately Anwar can't be joining us today because he probably have more pertinent questions than me. And tonight we have a fresh new face, Ridwaan, and Ridwaan is from 27 Four Investments. And Ridwaan, before I introduce you, I read that you are a Senior Analyst at 27/4. So can you just unpack that a bit for us?
Assalamu alaikum, Naim, and to yourself and to all your listeners. Yeah, sure. I guess, I mean, it's probably just in the nature of the role, and I guess my background. So I guess as a chartered accountant, post completing my articles, I quickly realized that what it wasn't for me, and started or ventured into the M&A or mergers and acquisition space, and then spent some time with one of the big firms, a couple of years there, and then joined 27/4, which is now sort of running on 3 to 4 years. And I think my role in the team is really an investment focused one. So I guess as an asset manager, you involved in really managing funds on behalf of clients, whether institutional or retail. And my role is obviously to actually get into the detail of the investments that we look at. And then I guess my focus for the past couple of years since I've been here has been private markets. So really just analyzing transactions and opportunities that come, or investment opportunities that come our way.
Okay, yeah, that kind of explains or it tells the listeners and myself more about what you do. And tell me now, you mentioned the word private market. Can you just explain what would be a private market and how would that differ from a public market?
So Naim, private markets really refers to investments in assets and equities that are not traded on a public exchange or stock market. So generally, for every public or listed sort of type of investment that is available out there, whether it's in the conventional sense, listed equities like buying shares on the JSE, for fixed income, you could trade in companies issue bonds on the JSE. There are private markets equivalents. Typically these are fast growing companies that are not publicly traded. A lot of the time, a lot smaller than listed companies. Obviously, the scale does change, or it is a lot wider when you compare the types of private market opportunities that are out there. I think in South Africa, we've probably got, I don't know what the number is, whether it's between 200 and 300 listed shares on the JSE at present. But if you look at, the number of private businesses in South Africa, we're probably in the tens of thousands, possibly even millions when you consider, informal trading enterprises, but investable private opportunities, there's obviously quite a bit out there. I think how they differ really to listed markets, it's things like access is probably the one. So access to private markets investors is a lot more limited to a smaller group of insiders, unlike public markets, which anyone can really trade on in their personal capacity through say an FNB or Easy Equities account, right? Things like the Companies Act also limits how private securities can be marketed and are traded. It's not just as easily available. Liquidity is another big difference. So, someone who's invested in a listed share will, if they need to liquidate their position or take their money out, it's quite easily tradable. They can really just sell their shares. There's a market price linked to the exchange. But in private markets, there's a lot less liquidity that is available to investors. It's typically long-dated investment opportunities that exist. I think the word obviously private extends into, just the nature of the transparency and availability rather of information that is out there. With listed companies or public markets, there's a lot more publicly available information on the company. If you go onto any listed company's website, you'll find their financial statements, their full annual report, as opposed to private companies, which you wouldn't find information. It's a lot more of a bilateral discussion, to actually access information that is typically a lot more confidential and closely guarded, as opposed to public markets type opportunities. And I guess lastly, I mean, all of that this really just culminates into private markets generally classified as a more risky type of investment opportunity for all of these sectors as opposed to public markets.
And yeah, so I'm not so I'm not too involved, or I don't get too involved in the private market investment type of investment. And so if you have to give me some examples of those, what would be some of those private investments?
So I think within private markets, right, you have a number of sub-asset classes with different instrument types and sub-strategies. And I'll try to unpack it a little bit, because all of these really have different risk profiles. So what I mean, firstly, by sub-asset classes, so private markets we see as an asset class in the investment world. And sub-asset classes really include things like infrastructure, renewable energy plants, telecommunication type of infrastructure, whether it's telecommunication towers, fiber network operators, those type of businesses. You get real estate as well. And obviously within real estate, you get different strategies like retail, industrial, residential, office type of real estate. And then you get generalist private equity. So these are just general private companies that are out there, whether it be manufacturing businesses, IT companies, retail companies, even agriculture. And I think within this space, specifically within private equity, it ranges from, depending on, the size of business, and that can be measured, say, by revenue, profits, assets. And typically, we look at it as SME, as really your smaller private companies that really grow to becoming what we term a mid-market company. And then you obviously get to upper mid-market before those companies really can think about, being big enough to become a listed share. And then finally, another example of a sub-asset class is venture capital, right? Which is a term that I think has really been a buzzword in the last sort of decade or so.
Definitely.
Really startups, fintech, tech-based companies, whether it's fintech, as I said, health tech, insurtech, disruptive, innovative type of businesses that come to market. Now, I purposefully, I guess, described it in this order because I think really the risk profile differs. I started off with infrastructure and real estate, typically considered lower risk in the private equity or private markets sort of asset class, given the physical asset underpin of infrastructure and real estate. And then obviously when you get to the other end of the spectrum, when you think about a tech company, it's really a startup, an early stage company with no real physical asset value, more risk in that, these ventures are may not be profitable yet, but has the potential to obviously grow off a low base and generate, risk-adjusted returns for investors.
And Ridwaan, now tell me, how do you guys find these opportunities? So, for instance, obviously a public company, right? All the information is available, the financials are available, PE ratios are readily available. All of the things that a typical investor would look for are readily available. So do companies approach you? Do you look at how do you find these opportunities? Because these are like you're looking for a diamond in the rough type of opportunities.
Yeah, you would think that, Naim, but I think given, what I said earlier, just if you think about the South African context, and obviously I've been in the space for a couple of years now, and so I guess 27-4 rather has been for the team that we've got around us has been in the industry for some time, and you really sort of get to understand how important relationships are. There's a number of different ways you can access these opportunities. A lot of it is relationship based. And for good reason in terms of being able to get access if there's a company that's really on a growth path and you happen to know one of the execs or one of the shareholders through someone in your network, that's a way of really, and they require more capital. It's a way of sort of connecting an investor to an opportunity. There are brokers that are out there in the market that really assist businesses when they're looking for capital. So if there's a private business that's looking for capital, whether it's shareholders that are looking to exit or sell their stake to bring in new shareholders, or they're just looking for fresh capital to really grow their business, and they don't want to necessarily go to, go the lending route. They're happy to give away some equity. They'll go to a broker. A broker will then, get in touch with, the buyer universe that they know about. And that obviously
So
that
a lot
comes
of
with
it,
pros and cons.
so a lot of it is really just networking, really. It's
Yeah,
you know someone, that guy knows someone. So
exactly.
because you have this network of buyers versus, not only say sellers, but
Yeah.
because you have both sides of the spectrum, you kind of network between those opportunities.
Yeah, exactly. And I think, I mean, the guys that really play in the space, if you think about private equity players in the market, a lot of the guys, when they look at starting a private equity firm, they really sort of have been in the banking world. They've worked for another private equity firm for, at least 10 to 15 years. So they've been able to build up, one, the experience, because it is a very, nuanced type of asset class in that it comes with a certain set of or technicalities that I think, it takes an experienced practitioner now to navigate, to really look at these investment opportunities, how to price them, how to assess risk, how to assess, the potential for returns. But obviously over that 10 and 15 years, you also then build your relationships in the market, whether it be brokers, or anyone else that allows you to be able to build this pipeline. I think, at 27-4, what we've done over the past couple of years is that we've been investors through our fund of funds vehicle into underlying private equity firms. So we one
Okay.
layer
So
removed from
can you
the actual.
unpack that for us? What would that mean?
Yeah, sure. So I think we act as really intermediaries between, where a lot of the capital in our country resides, being the retirement fund industry. So that's really a big part of our client base, of the institutional investor base. And we, I guess, have the know-how in terms of understanding and the relationships really across a number of underlying private equity players in the market. So we really assist our clients, which are the retirement funds, with how to assess private equity fund managers who are looking to invest into underlying businesses. And as part of choosing the right investment opportunity at our level, so we don't invest directly, say, in a company that's on the ground. We do it via a private equity fund, hence the term fund of funds. And one of the core things that we really look at in assessing whether someone we believe we want to back someone is looking at their ability to generate a pipeline. And really what that means is, let's look at what opportunities do they currently have, and that demonstrates, I guess, the relationships in the market, whether it be through brokers or other networks that they've been able to build up. What does that translate into potential opportunities? Is it really specific to a certain sector? There's obviously a host of things that we would look at in addition to pipeline, whether it be track record, their skin in the game, a lot of different vectors that go into it. But in effect, we're really just an intermediary between retirement funds and underlying private equity firms. And I think the benefit for our clients is also an added layer of expertise, but also diversification, which is obviously very important in asset management. Not putting all of your eggs in one basket, but being able to spread it across, a number of opportunities, so that you really spread your risk to try and optimize your upside.
And tell me, regarding investment now. So I'm an individual investor. I want to invest into a private market. I don't want to trade on the GSE. How can I, as a private investor, access these private markets? Is that a possibility? And how would 27-4 facilitate that?
So I think, I mean, as an investor, you'd probably want to, I think you need to have an appreciation for some of the risks that private markets brings. It's obviously, as I mentioned just a couple of minutes ago, it is generally considered more riskier than public markets. So we wouldn't encourage, an investor that's, really saving for a short-term goal, or saving in the short term to invest in private markets, given some of the challenges around liquidity. As I said, you're not able, if you're putting your money in it, it's typically long dated. It comes with a lot more risk than other investment opportunities that are out there. But assuming you are, say, an investor that has, quite a bit of excess wealth, you've already invested, into things like the JSE listed companies, got a bit offshore and you're now just looking for a small bit of your portfolio to really, give you a bit better in terms of its returns relative to what else you've got. It is definitely something I think that we can facilitate through 27/4. Obviously, we've got specific strategies and sub-asset classes within private markets that we're pursuing. One of those is venture capital. We recently launched a venture capital fund, which is very specific. It's looking to back and invest in startup tech businesses, but businesses that are importantly, we've been very specific around defining what criteria those opportunities need to meet. Examples of those is that they need to be post-revenue, so they can't just be, these businesses can't just have, a proof of concept that they're still trying to break into the market. They need to already have that bedded down. They need to already demonstrate that they've got established relationships with the large players so that, they're starting to generate some revenue. They may not be profitable, but we can see that, or they can rather demonstrate to us that there's a path to growth or to consistent growth, and I guess risk-adjusted returns that would be attractive for us. So that's one of the opportunities that we're pursuing within 27/4. What we've done and that's, traditionally, private markets has been an asset class that has been, more suited to institutional investors. Now, institutional investors really just means other asset managers and pension funds in the industry. But we're trying to make it more accessible to obviously retail investors, which are individuals, and a big part of our client base as well. Because I think there are a lot of individuals that do have the appetite, they have excess wealth. They're looking to allocate a small portion to these really niche opportunities in the market that are not available on a listed exchange. And we do those typically through, endowment type structures. We recently, created a structure through an endowment, which obviously comes with tax benefits for individual investors, obviously subject to certain, restrictions in terms of keep holding that investment for 5 years. Now, a venture capital investment is typically, the strategy that we're pursuing means that if you're giving us your capital, you're typically locked in for around 5 to 10 years. There's not going to be, it's not dividend paying companies. The excess profits that these companies generate, they're really just using to reinvest for their own growth. So you've almost got to buy into the fact that, there is a long play here, a long growth play, but obviously over this 5 to 10 years, we're looking to choose the right investment opportunities that can generate this, say, in excess of 20, 30% per annum over that time frame, which is not easily achievable, across listed asset classes. But again, I think to really directly answer your question, there are certain structures like an endowment that we've created at 27/4 to be able to attract, individual investments. But obviously, the investor would need to appreciate, some of the risks that comes with it. One of the most obvious ones, as I mentioned, is the illiquidity or the liquidity profile that is linked to this opportunity.
And you mentioned, well, you mentioned just now that typically these horizons for investments are between 5 and 10 years. So if I was an individual investor, and you mentioned that there are these endowment type policies available where I could kind of invest. So upfront, would you tell me that your money is going to be locked in here 5 to 10 years with the potential return of, say, 20 or 30%? How would that work? Like, I mean, is there available at 27/4 these policies with that type of view? Do you find these investors? Because I mean, that's a long time to hold your money in an investment.
That's right. That's why I said it takes a sophisticated sort of, and I say sophisticated in inverted commas, because what I mean by that is really an appreciation for the risk profile of these investments. That, we're not guaranteeing a 20, 30% return, but we can demonstrate the processes that we've got in place to be able to find these opportunities that are giving these type of returns, right? One of the examples of one of the opportunities that we've got is a medical tech or health tech company that is looking to, that almost is, it's an AI solution that is looking to really just automate and improve the pathology space, and I think, there we're seeing, a massive impact and growth play, not only in South Africa, but across the continent, where traditionally in a remote area, if you're taking a blood sample or a tissue sample, you've actually got to courier that to a specialist in a metro. If you're sitting in a rural area, you go to a lab, they take a sample. If it needs a specialist, you've actually got to courier that blood sample. And this company that we've invested in actually digitizes and uses AI to be able to do that a lot faster. And I think, if you think about the impact that has across, healthcare, not only in South Africa, but across the continent, where the skills available is not as much as, developed markets, etc. It's a growth opportunity that we've tried to vet as best we can. We like the management team that's running the business, the experience that they've got. We like the traction that they've been able to make in the local market with some of the big labs. We can see that they've already got contractual arrangements with some of the big labs. And we've obviously done quite a bit of detailed work to really assess what does their growth trajectory look like. And because they're really growing off a small base, the potential for that 20-30% return is obviously a lot higher than, a larger company that's at scale and that is more likely to grow, alongside GDP or slightly outperform GDP. And I think that's an important point, is that these companies operate in really niche sectors of our economy. So they're not exposed to the economy as a whole. And within these little niche sectors, whether it's health tech, whether it's, logistics that is servicing a specific type of mining company or commodity sector, we spend a lot of time assessing the market, both locally, globally, for longevity. We really assess, the underlying contracts that these companies have with their clients. We do technical assessments of their technology, and that's part of what we sell, right? The fact that we like to believe we have the capabilities to do that, and hence give our investors comfort, that we will find the right opportunities that can give you a 20-30% annualized return over that 5 to 10 year period. But it does take time, obviously, to achieve that return. We're not promising, unicorn type of investments that are going to give you 30 or 50% within 2 years. It's going to take some time really for a ramp up to happen. Yeah, I'll probably leave it there.
No, I find that fascinating, because it's not your traditional, investment. These are like, and you won't typically see these type of investments typically, and that's why I suppose there are these facilities available. We're going to jump to a quick ad break. Once the ad break is done, then got a lot more questions that I want to ask.
Exactly. Thanks, Naim.
We're back again. That was a quick ad break. So just coming back, Ridwaan, you were mentioning about the investment horizon and the potential returns, which I found very, very interesting. But obviously in South Africa, we faced with, I mean, just macroeconomically, we faced with a lot of challenges, obviously. Well, I'm from KZN, and in KZN we had the unrest, and now looking forward at the elections. I mean, a lot of the traditional investment houses, like your Signia and all of those investment houses, they're trying to diversify investment offshore. Like there's this big move to tell everyone, no, shift money offshore, diversify offshore. But then conversely, you're saying there's lots of potential here. I mean, in private market. So how would you sell that versus what we are traditionally hearing now?
I think, Naim, I mean, what we're seeing is that, and it obviously there's obviously opportunity offshore, both lists within the public markets and private. And we've got access, and we know about there's quite a few private market fund managers or investors that we've looked at that play both in emerging markets across our continent or elsewhere, but also play in developed markets. That are looking to invest in things from hydrogen to infrastructure to innovative tech companies. But I think there's still a need for capital within our economy, right? And I think there's been changes to, for example, retirement fund legislation quite recently that is trying to boost investment to infrastructure. Infrastructure in the investment space has been something that's been quite topical. I think it's well documented, in public domains that within the African continent and still within South Africa, there's a significant need for infrastructure investment to stimulate economic growth. I think if you think about what's been impacting our economy locally, something like load shedding, right? Definitely is a challenge for businesses, but I think we've seen quite a bit of resilience in the private markets opportunities that we've got exposure to. We've seen businesses being able to trade through, really look at alternative sources of energy, which I think not only is the residential market doing, but also, it's been a growth factor for the commercial market. We're seeing a lot of opportunities in the renewable and sort of ancillary type of services. The one that comes to mind is things like battery manufacturing. In the last sort of 2 to 5 years, there's been a large influx in battery manufacturing opportunities, which presents an opportunity for growth in the face of a challenge that we're facing. And I think that's just one example. Technology and tech type of investments is another. I think the rate of technological advancements across different sectors, whether it's financial, insurance, healthcare, is something that's not only happening offshore, but it's happening locally as well. Obviously, these investments, these companies are still small, but they are gaining traction. So you're not going to hear about them. Obviously, they're not going to make news headlines necessarily every day because they're still really a small part of the economy. But they represent these little niches or opportunities of growth that, if you know how to find them, like many private markets investors do, as we touched on earlier, sort of how to find these opportunities. We're seeing a lot of these opportunities that still exist for growth because of just, inefficiencies and challenges. There'll always be solutions that people come up with, and you'll be surprised just as to how many companies there are out there that actually have performed well. Post-COVID, we actually had, to cite an example within our portfolio, post-COVID, within our portfolio through one of our underlying fund managers, we had access when invested in a logistics company that was supporting the commodity sector in a specific commodity, not just broadly, all of the mines, but a very specific commodity. And that business actually had managed to grow by 2 or 3 times its earnings in the last 2 or 3 years. So they're literally doubling and tripling their earnings within the space of 2 or 3 years. And this is a business that's probably, worth, say, 100 million. So it's not just a tiny business, right? But it's because of global factors, local challenge. Transnet is another challenge that we've had as an economy, and the issues that we've had from a transport perspective because of the issues, that Transnet have had on the rail side of things. But that's provided this opportunity for this logistics company to really unlock, their growth through continuing to service the existing customers, which are also, growing on the back of, what's happening on a macro level. So I think the summary point is that, private markets opportunities are not as linked and directly affected by, things that are happening at a macro level. And that's what makes it attractive, right? If you invested in the JSE, it's a lot more volatile because of, and there's a lot more impact to share price because of market sentiment. We've seen what happened with Russia, Ukraine, and the impact on listed share prices. That doesn't happen, as significantly at all to private markets investors. Valuations are not impacted by sentiment. Yes, there is some indirect impact, and we've seen that where, what happened with Russia, Ukraine. I think there was a global impact on global supply chains, and some of the businesses that we had on a very strong growth trajectory, but that actually had slowed down because they couldn't import as much as they usually did from some of their components from China, right? So the point being is that it's not completely removed from global macro trends, but they are somewhat shielded because of again going back to the niches and the little pockets of the economy in which they operate.
And my other question is on foreign investment. So obviously, South Africa would be cheap for a foreign investor because you keep on. So it's $1, you're dividing by 20, pound, you're probably dividing by 25. So it's a big division game for them. Do you find a lot of foreign investors directing their money towards you guys? Are you guys seeing that, or is sentiment still negative?
No, I think it's mixed. I think within the private market space in which we've operated, which is really generalist private equity, as opposed to, infrastructure, real estate, that hasn't been a core part of our strategy, but it is something that, we've come across opportunities in those asset classes. But, when it comes to general private equity, we often sit alongside foreign investors, which are primarily development finance institutions. So these are, really foreign governments in the Nordic region, so countries like Norway, Finland, France, even the British government has a development finance institution, and a component of their strategy is to invest in emerging markets for growth. And we've seen those players, continuing to play in our market. Quite recently, as 27/4, we completed, a social housing investment at the end of last year, and that was alongside the French development finance institution. So we're seeing a little bit of that. I think what we're finding to become a lot more prominent from foreign investors is that they're really viewing, and it's a function of their strategy, right? Is that they look at Africa and sort of want to have exposure across the continent as opposed to just South Africa, because for them, there isn't really an incentive to just go into South Africa. Yes, there's opportunity, and a lot of them have invested in South Africa for many, many years. They've been playing in our sector and in our country, in our economy, and investing in our economy for a long time. But there's obviously other countries around us that are seeing good growth. Namibia has been had a good growth story in the last year or so. I think they were one of the top 5 ranked countries globally on foreign direct investment. East Africa, countries like Ethiopia, Kenya, for a long time, has also had a good narrative in terms of the economic growth that they're seeing. So a lot of the developed markets, like, Britain, Europe, less so the Americas, more so in Europe, are continuing to invest in South Africa, but are seeing a lot of opportunity also from what I call our competing counterparts in the rest of the continent.
Yeah, that is interesting. Generally, you would think, especially from those, so I suppose for them it kind of plays a lot in the hands of like a sustainability type of push towards Africa. They can tick something on their scorecard type of thing.
Exactly. I think to just add to that, it's a good point that you make, Naim. A lot of their mandates are also, because by the nature of being a development finance institution, they want to invest to really promote global economic growth, reduce things like food insecurity. They want to enhance economic growth in these countries, and will invest not as much to try and extract as much return as possible, but to really make a good social impact. A lot of their strategies are typically focused on things like climate change. They'll specifically look at opportunities that are addressing climate change, because we know globally that's on the agenda of many global large investment corporations, or they'll be investing for job security or to reduce food insecurity, those sort of things. So there is that social aspect and impact that they're looking to achieve. And I think that Africa really provides as an opportunity as opposed to other developed markets.
Interesting. Okay, Ridwaan, sorry, we have to jump to another ad break, and then 1 or 2 questions, and we can wrap up. Okay, we're back. And this has been truly fascinating. There's lots that I've personally gained from this in terms of private market. I generally, we tend to play a gambling game with the JSE. But this year, it's really opened my eyes differently in terms of private markets. Just one thing that's always on everyone's mind, Ridwaan, is Ponzi schemes. Someone in to make a quick buck, and obviously that it leads to what is the regulatory environment around private markets. I'm not, obviously the JSE, it has a proper, well, not Steinhoff, but I mean generally there's rules and regulations that need to be followed. So what regulatory platforms would you guys need to comply with?
Yeah, I guess very much like you putting your money with any asset manager, whether it's through a unit trust or any other sort of product. As asset managers, we've got to have licenses with the FSCA, or Financial Services Conduct Authority. And I think within that, we obviously allowed to do discretionary investments into various asset. Those licenses are linked to one, making discretionary investments, but also into specific types of securities. Particularly in private markets, it's either private credit type of opportunities or shares. So the right licenses need to be in place. I think it's also understanding and having an appreciation for the skill set required in navigating private markets. It's quite, as I said, the guys that typically operate in this space as investors, as private market or private equity investors, have spent 10, 15 years in the industry before trying to do it on their own. And it takes a long time to really understand the dynamics of, and how to assess a good opportunity, how to vet the opportunity, how to do evaluation. These are companies that are not, there's no share price that's linked to the JSE. It's a valuation that can be quite complex. There's obviously a number of assumptions and risks that you've got to take into account. It's a bit of an art, it's a bit of a science, and I think it just really comes with years of experience. So before you allocate your money with, or invest through an asset manager or any opportunity for that matter that is not a listed opportunity, I think it's really just, doing your research and trying to really understand how are returns generated, and doing it through an organization that, you believe has the capabilities and can demonstrate, a track record in this space, given the fact that it is riskier. There are, you need to understand the liquidity profile of the investment. And I'm not saying all private markets investments are illiquid. There may be some that do offer some liquidity. As you say, that can be associated with, in some instances, Ponzi schemes. But it's having appreciation for what the regulatory environment is like. You can talk to your financial planner. You can, talk to your own investment houses, whether it's, if you've got money with 27.4, you can obviously engage us, just to take advice, from I guess, our brokers. But I think as an investor, you've got to have some appreciation for the fact that there is risk and understanding what those risks are and how do they actually translate into opportunities. It's quite important.
And one final question, obviously, people listening who have the liquidity to get involved in these type of investments, how would they contact you, or is there and what's your website? Where can they get additional information from? Maybe just discuss with that information.
Sure. So our website is www.274. So that's the number 27 and the letters four.com. And on there, I think our website is dynamic in the sense that it sort of, looks to whether you are institutional or retail investor, and there's contact details obviously on there. You can leave your details for us to get in touch with you. We've got a retail team that will contact possible or interested investors directly. And I think there is some marketing material that is both on our social media platforms that you'll find on things like Twitter and LinkedIn, or X rather, and LinkedIn, that also has a bit of information around what are some of the opportunities. And I think our contact details are on our website, and we're more than happy to reach out to interested investors and talk through the opportunities that we have available and how we can, help investors access them.
Well, thank you, Ridwaan. Our time is up. The producer told me don't be late because there's another program starting. But yeah, I've definitely gained more insight into the opportunities in private markets, risks and rewards attributed to both. And I think you explained it well. So thank you for that. And yeah, that's really it from the show. And I'm sure the listeners will definitely find your details and contact you. But yeah, that's it from us. Thank you very much. Assalamu alaikum wa rahmatullahi wa barakatuh.
Jazakallah. Wa alaikum salam wa rahmatullahi wa barakatuh.